Welcome to The Explainer. Today, we're putting AMC through the ultimate data-driven investigative case study. We are stripping away all the hype to find the fundamental truth. As your equity research analyst, my job is to be an investigative journalist of these financial statements. We're looking at the raw numbers, the buried footnotes, and the accounting realities that the headlines always miss.
Now, before we get into the weeds, I need to read this mandatory disclaimer to ensure we stay perfectly objective and compliant. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
So look at this massive disconnect sitting right at the top of their latest filings. On one hand, AMC just hit its highest quarterly revenue in its 106-year history at a staggering $1.6 billion. They also posted a record-adjusted EBITDA of over $321 million. But look at the bottom line. They still posted a brutal GAAP net loss of negative $11.4 million. How does a company break a century-old revenue record and still lose money? Well, that is the exact mystery we are going to solve today.
Here's our roadmap for The Explainer. We'll run through the valuation gauntlet, uncover the hidden red and green flags, apply the legendary investor test, and finally, deliver the ultimate verdict and moat analysis. Let's get to it.
Starting with Section 1, the valuation gauntlet, where we test AMC against 21 rigorous financial models.
When we apply our first group, the cash flow models, the math just completely breaks down. Thanks to erratic historical flows and a massive debt load, your standard discounted cash flow models, they're completely non-applicable. Even metrics like free cash flow to equity yield exactly $0. And why is that? Because their massive $3.8 billion corporate debt completely consumes any leftover value that would normally go to you, the shareholder.
Moving on to Group B, which looks at dividends and income. Traditional dividend discount models return exactly $0 mathematically, simply because, AMC pays no dividend. But it actually gets worse when we look at the residual income model. It outright fails because AMC carries a crushing negative book value of $1.5 billion. Basically, their operating losses completely fail to cover their heavy capital charges.
All right, Group C, let's look at market comparables, and the reality check definitely continues here. AMC screens as structurally overvalued compared to profitable peers like Cinemark. Because they operate at a loss, a trailing PE doesn't even exist, and their forward PE sits at a staggering 258 times earnings. Add in an enterprise value to EBITDA of almost 16 times, and these multiples are absolutely screaming extreme overvaluation relative to historical sector norms.
In Group D, our traditional asset-based models literally collapse under the weight of the company's liabilities. Net asset value is deeply negative due to that $3.8 billion debt. So, think about it. If AMC had a hypothetical fire sale liquidation tomorrow, the value is $0 per share. That massive debt load entirely wipes out equity holders.
Finally, Group E. Applying advanced real options valuation yields, well, exactly $0. Applying Black-Scholes logic fails here because there are no hidden tech pipelines or untapped disruptive expansions waiting to save the day. Their capital expenditures are strictly going towards basic maintenance and premium seating just to retain the audience they already have.
Moving to Section 2, 7 hidden red flags. These are the media blackout metrics totally ignored by the headlines.
Okay, so here are 7 massive red flags buried deep in the footnotes. We've got relentless shareholder dilution. They raised $285 million via equity in Q2 alone. Then there are persistent GAAP losses, a $3.85 billion corporate debt load, and negative interest coverage. Add to that $114 million in debt extinguishment costs, a negative stockholders' equity of $1.5 billion, and a shrinking footprint with 159 closed theaters. Now, why won't you hear this on the evening news? Because complex mechanics, negative coverage ratios, and shrinking physical assets completely ruin a flashy, soundbite-friendly growth narrative.
Now for Section 3, 7 overlooked green flags. Let's look at the hidden operational triumphs buried in the filings.
To be totally objective, we have to look at the bull case, and this brilliantly illustrates it. AMC operates on a massive fixed cost base. This means that when people actually show up to the theaters, the incremental revenues drop violently straight to the bottom line.
This intense operating leverage is exactly why a 14% revenue increase translated into a 70% surge in adjusted EBITDA. And there are more overlooked green flags here. S&P just upgraded their credit rating to B-. They've successfully extended their runway with zero near-term debt maturities until 2029, and Q2 actually saw a free cash flow explosion to a positive $190 million. Furthermore, interest expenses are dropping, overseas EBITDA surged an astonishing 336%, they are sitting on a $778 million liquidity cushion, and institutional giants like Vanguard are accumulating shares. The mainstream financial media largely ignores all of this because they're hyper-fixated on retail day traders and box office ticket sales, completely missing that management has actually successfully reset the existential doomsday clock.
Section 4. The Legendary Investor Test. Let's see how the investing grades would grade this stock today.
First up, the father of value investing himself, Ben Graham. He looks for a PE under 15 and a positive net current asset value to calculate his famous Graham number. Well, AMC fails instantly. Ben Graham would walk away without a second glance because you simply cannot calculate a Graham number when a company's book value is $1.5 billion in the red.
Next, we run Peter Lynch's growth test. Lynch looks for growth at a reasonable price, targeting a PEG ratio of around 1.0. With AMC, the forward PE is sitting near 258 times, which makes applying the Lynch fair value calculation mathematically absurd. So this stock fails the Lynch test by a country mile. Finally, Warren Buffett's quality test. Buffett requires a consistent return on invested capital greater than 15%. AMC fails across the board here too. Their ROIC is a measly 4.47%, meaning it completely lacks the durable economics that Buffett demands. Plus, that heavy debt load absolutely obliterates any true owner's earnings.
And that brings us to Section 5, Final Verdict and Moat. It's time to synthesize all this data into a brutal reality check.
To understand a company's long-term survival, we have to define its economic moat, a structural business advantage that protects long-term profits through things like switching costs, network effects, or cost advantages. Unfortunately for AMC, they lack all of these. I mean, there is no switching costs for you, the moviegoer, to simply drive across the street to a Cinemark if the showtime fits your schedule better, right?
So let's bring it all together, starting with our valuation verdict. Based on the abject failure or negative outputs of virtually all 21 rigorous valuation models we tested, the stock is structurally overvalued on a fundamental basis. The current enterprise value is just entirely disconnected from the actual cash flows the underlying business can generate for equity holders.
Next, looking at the moat trajectory. AMC's economic moat is exactly 0, and over the next 3 years, that non-existent moat is actively shrinking. Upgrading seats to premium formats is a necessary maintenance strategy just to survive, but it's not a structural advantage. Healthier competitors can easily replicate those screens, while AMC is simultaneously forced to shutter its underperforming locations.
And here is your clear, nuanced takeaway. Operationally, AMC management actually deserves some credit. They just proved that a normalizing box office translates to violent EBITDA growth. But financially, they are heavily diluting shareholders just to survive. The cost to keep those lights on is exceptionally painful, and the ongoing dilution means you are left holding a smaller and smaller piece of a heavily indebted pie.
We've run the gauntlet. We've read the footnotes, and the math doesn't lie. The models scream overvaluation, but those hidden operational green flags do suggest a powerful engine exists underneath all that debt. So the question remains. The models are pointing one way, but hidden flags suggest a storm. Which side of the trade are you on? Do your own homework, and I'll catch you in the next explainer.